We have just now talked about a base case situation and lump sum purchase. Sometimes, instead of purchasing asset from outside, firms may decide to construct the asset by itself. So this situation is called self-constructed asset. And the question here is, under this situation, what to include in the capitalized cost of the asset? So the cost of a self-constructed asset is computed. It is computed in a similar manner to the cost of manufactured inventory. If you think of what kind of cost we include in a manufactured inventory, so it includes the cost of raw material, it includes the cost of direct labor, overhead. However, there's something special here for a self-constructed fixed asset. We may also include interest cost here. I'm going to talk more about it in a minute, but in a word here, so if a firm decides to self-construct an asset, sometimes in order to self-construct the asset, firms may need to borrow from a bank or borrow from outside in order to construct that asset, because asset usually it takes a lot of capital. And when the money borrowed is used in self-constructing the asset, so we know that usually interest expense needs to be expensed. However, if that money is used in self-constructing an asset, the firm may capitalize part of that interest expense. Or in other words, instead of expense it in the current period, the firm may put it in the cost of the asset and to depreciate it gradually later. So this is the interest cost here, which is a little bit specific for the self-constructed fixed asset. And here, as I just said, firms have loans outstanding during the year and pay interest on those loans. Interests are usually expensed. However, if firm self-construct fixed asset, it can capitalize part of the total interest. So, or in other words, if part of that loan is used to finance self-constructing fixed asset, some of that interest expense can be capitalized. We can put it into the cost of the asset. And the general entry here is to debit PP&E, debit interest expense and credit cash. So as you can see here that the credit cash, the cash is the cash interest we paid out. And part of this cash interest, it can be capitalized into the cost of the asset. And the other part, if it cannot be capitalized into the cost of the asset, it needs to be expensed in the current period, which is by debit interest expense. So, and then regarding interest capitalization, there are two key issues here. The first one is period of capitalization, or in other words, so the normal case general entry when the firm pay out interest is to debit interest expense and credit cash. So this is the normal case. If the firm does not have capitalized interest, this is the general entry we should make. So all interest expense should be expensed. However, if the firm is using part of that financed capital to self-construct a fixed asset, so and then we can use this general entry. Which the only difference here is compared to the normal case, now we can capitalize part of that interest expense into the cost of the fixed asset. And then the first key issue here is the period of capitalization, or for how many periods, or for if the firm is making this journal entry every month, for how many months the firm can keep making this journal entry until it needs to go back to its normal case journal entry to record interest expense. So the period of capitalization, for how many periods we can make this journal entry. And then the second question is amount of interest to be capitalized. Or in other words, what is the, So what is the amount here that can go into the cost of the PP&E, the fixed asset? So that is the second question. And regarding our first question here, the period of capitalization. So the rule here is we start interest capitalization when the first expenditure is made. Activity are in progress to get the asset ready for its intended use. Interest costs are actually being incurred. So those are the criteria. And then we stop the interest capitalization when asset is substantially complete and ready to be used by the company. So that is when we can start interest capitalization and when we need to stop interest capitalization. And again, interest capitalization just means that we can capitalize part of the interest into the cost of the asset. So, or in other words, we use this journal entry instead of this journal entry. And then the second question, the amount of interest to be capitalized. So here we use something called avoidable interest, and it cannot exceed the actual interest incurred during the capitalization period. Or in other words, if you incurred $50 in actual interest during the period, whatever interest you capitalize, it cannot exceed $50. And then, so we use avoidable interest here. What is avoidable interest? Avoidable interest is the amount of interest that could have been avoided if expenditure for the asset had not been made. So if we had not been making those expenditure to self-construct the asset, we can avoid those interests. That is the avoidable interest. We're going to look at an example very shortly. It's not hard to calculate, and sorry. So it is not hard to calculate at all. Once we look at the example, you'll understand it. And to determine the amount of interest to be capitalized, so basically we have 3 steps here. The first step is to determine the weighted average cumulative expenditure for the capitalization period. So what is this? We're going to look at it through the example. And then the step 2 is to determine the appropriate interest rate, compute avoidable interest by applying appropriate interest rate to weighted average accumulative expenditure. That is step 2. And step 3 is to capitalize the lesser of avoidable interest or actual interest. So what do we mean by these 3 steps? Now let's look at an example. Construction begins on February 1st and ends on December 31st. The firm borrowed $30,000 with 7% interest rate to finance the construction. The average interest rate on other borrowing is 9.9%. Total interest incurred during the construction period is $5,000. And we have the date for each expenditure here. Please spend 5 minutes. First, try to work it out by yourself. And we're going to go through it shortly, but please try to work on it by yourself first. You can pause your video for now. Okay, so let's look at how to solve this problem. First of all, let's write out the date and the amount for each of the expenditure. So this is a timeline. And on February 1st, the firm incurred $5,000. March 31st, $28,000. July 1st, $21,000. October 31st, $32,000. December 1st, $14,000. And the construction begins on February 1st and ends on December 31st. That is when it ends. So step one. Step one is to determine the weighted average accumulative expenditure. So what is this weighted average accumulative expenditure? It is the weighted average accumulative expenditure, right? So literally by the words, it is the accumulated expenditure, meaning that we need somehow add all of those expenditures up because it is accumulated expenditure, but it is also weighted average. So what do we mean by weighted average and weighted by what? We are weighting it by the period. By the period we're using this expenditure. So for example, for the first 5,000, we're using it for, that is how many months? 11 months out of 12 months. So this expenditure, we have from the time when this project begins until it ends, it is in use for 11 months out of 12 months. And then for the second expenditure, we're using it for 9 months. For the third one, that's 6 months. And then 2 months and 1 month. So we need to weigh the expenditure by the period where we're occupying that expenditure. Or in other words, during this 11 months, this 5,000 has been put into this project, and we cannot. So in other words, we cannot put it in any other alternative use. It has already been occupied by this project. So that's 5,000. And then we multiply it by 11 out of 12. And then for the next 18,000, it is in use for 9 months out of 12. And then for the next 21,000, 6 months out of 12. The next 32,000, 2 months out of 12. And the last 14,000, 1 month out of 12. So as you can probably see here, this is the weighted average. So it is weighted average accumulative expenditure. We're accumulating it because we're accumulating it by adding them all up, but not every of them are equal. They're not equal because some of them incurred earlier, some of them incurred later. So for example, the firm can go in to borrow 5,000. So the first 5,000, the firm needs to go in at February 1st to borrow this 5,000. And it is in use for 11 months until the end of the project. And then the next 28,000, the firm doesn't need to go in to borrow it at February 1st. The firm can just go in at March 31st to borrow it. So this expenditure, the firm is only using it is only, the interest is only for 9 months. And then for the next one, the firm can come in at July 1st to borrow this 21,000. So the interest for this is only 6,000. It's only 6 months. So you can see here, because of the timing of these expenditures, they're not all equal. And so that's why we need to weigh them according to the months we're using those expenditures in the project. So, and then this will give us $41,583. So, and this is called weighted average accumulative expenditure. So that is step one. And step two is to compute avoidable interest. So avoidable interest, as we just mentioned, it is the interest that can be avoided if the firm has not taken up this project. And then, so let's first look at, so we have two interest rates here. One is 7% interest rate that is borrowed specifically to finance the construction. The other is 9.9%. So that is for other things. And here, so we have weighted average accumulative expenditure of 42,583. And so as you can see here that this amount already exceeds the amount we borrowed specifically to finance the project. Or in other words, for this 8% interest rate, it can only, the maximum amount it can apply to is 30,000. However, the actual expenditure we kind of used in this project, it is more than 30,000. So what can we do with the rest 12,583? So this is the amount, 12,583 is the amount in excess of the 30,000. And for this amount, we can only apply our normal interest rate, which is 9.9%. So the avoidable interest is these two parts adding together, and this gives us 3,346. So this is step 2, and this is the avoidable interest. And step 3 is to capitalize the lesser of avoidable interest or actual interest. So in this step, we just take the avoidable interest and compare it with the actual interest. Our actual interest is 5,000. So in this situation, our avoidable interest is less than the actual interest. So here, we just capitalize the avoidable interest. And in some situations, you may find your avoidable interest more than your actual interest. And in that situation, we can only capitalize the actual interest. Or in other words, we capitalize whatever is smaller. And the journal entry here is to debit PP&E for 3,346. Debit interest expense for, we're going to calculate it in later, but let's write out the credit side first. We credit cash, so cash interest paid is 5,000, and which means that the difference between these two, which is 1,654, that is the interest that can be expensed. So this is one example. And now let's look at another example. Construction begins on March 1st, ends on December 31st. A loan of 100,000 for the construction is obtained with a rate of 7%. The average interest on other borrowing is 9%. Total actual interest incurred during the construction period is 20,000. How much interest to capitalize? So please first take 5 minutes, work on it on your own, and you can pause your video for now. Okay, so let's first draw the timeline. The first expenditure is March 1st for 100,000. The next one, April 1st, 100,000. May 1st, 100,000. June 1st, 100,000. July 1st, 100,000. And the project ends on December 31st. So the first expenditure is occupied on the project for 10 months. The second one is occupied on the project for 8 months. The third one occupied for, the second one is 9 months. The third one is 8 months. And we have 7 months and 6 months. So step 1, weighted average accumulative expenditure. We weigh each of the expenditure by the period it is occupied on the project. And then the first one is 100,000. It is occupied for 10 months. The second 100,000 is occupied for 9 months. The third 100,000 is occupied for 8 months. The next 100,000 occupied for 7 months. And then the next one occupied for 6 months. So we have 333.33 thousand. So this is step 1, weighted average accumulative expenditure. Step 2, avoidable interest. Avoidable interest is calculated as, so this 333.33 thousand, and out of this, only 100,000 is obtained with a rate of 7%, which means the rest of it is 233.33 thousand. So for 100,000, we can apply the 7%. For the rest, 233.33 thousand, we need to apply the 9%, which is the rate on all of the other borrowings. And then this gives us 28,000. So this is the avoidable interest. And then step 3, we compare 28,000 with the actual interest 20,000. So in this situation, the avoidable interest on this project is more than our actual interest. So we can, because like our avoidable interest is bigger, we take the whatever is smaller, we can only capitalize up to our actual interest, which is 20,000. So interest to capitalize is 20,000, and the journal entry is to debit PP&E for 20,000. Credit cash Yeah, sorry. Let me just write out the journal entry here. The journal entry is to debit PP&E for 20,000 and credit cash, that is the cash interest paid for 20,000. So this is how do we, so this is basically the self-constructed asset. Most of the self-constructed asset, we capitalize it very similar to when we build up an inventory, so raw material and etc. And the only part specific to self-constructed fixed asset is capitalized interest. And here is the journal entry. So, and how to calculate the capitalized interest. So this is self-constructed asset.